Home prices are skyrocketing. Housing inventory is at its all-time lows. Home buyers have to contend with multiple bids and especially those dreaded cash offers. Can this last? No, it can't. Markets always will find balance, and balance is always a good thing. It does not mean housing market is to crash. We've talked about this on our previous episodes very many times of the fundamentals, why the market isn't crashing, but these interest rates going higher may be one way of helping the markets. The spring market also is helping a little bit with inventories so that we can see a bit healthier of a housing market in front of us. There would have to be a ton more homes out there before we could talk about a potential crash. Just keep that in mind. In other economic news, last week was somewhat of a quiet week, but the Fed once again took center stage. The minutes from the meeting from March 15th have been released, and that really shattered the market quite a bit. Fed comments regarding their plans for addressing inflation were pretty harsh, and talks about further hikes on the Fed fund rate also brought up that volatility in the mortgage interest rates market, mortgage-backed securities, and such. In other news, CoreLogic's home price index for February showed prices rose 2.2% comparing to January and 20% year over year. Yes, there are some pockets, for example, in the city where the condo market is not as hot and as steaming as the single-family home market out there in the suburbs would be. The annual acceleration reading is up from 19% reported just a month ago, and this is at a 45-year high, 20% on annual basis, and this is on average. Jobless claims were reported at 166,000 of new claimants, new unemployment claims, which brings it to the lowest level since 1968. And this also means that we have right now a little over 1.7 million people collecting unemployment altogether. Staggering would be a comparison of over 18 million just a year ago. The minutes from that Fed meeting could be analyzed, and I'm gonna dedicate a full other episode to talk about this, but we have to be very careful looking at Fed's comments and moves, because it really has a tremendous effect on the mortgage interest rate industry. When it comes to mortgage interest rates, yes, they are high in comparison to what they were over the last 2 years, and we are talking increases in some cases over 2%. However, and this is an important however, historically speaking, a 5% interest rates are still below average. An average interest rate is between 6 and 7% on a 30-year fixed mortgage, and we've got a bit of legwork to get there. So affordability stands pretty okay now because wages and income is increasing just like mortgage interest rates are increasing as well. That's all I had for today. Beata Bukowski, over and out.